Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I author in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player.
Good day all. Ira Epstein of Linn Associates, and yes, I'm back and I'm healthy again, and I appreciate so many of you that wrote onto our YouTube, get better, miss you. I did appreciate all that. But it is Tuesday, the 20th of February, 2018, and we're just getting on to 4:45 p.m., so the boards are going to erase soon. As you can see, a mixed day. The Nasdaq was up, but all the other indices were down. We had a late day rally that carried the Dow back up here because it was down about 340 points. Notice how all the metals got hit today at the expense of the dollar going higher and everything else coming down. Part of that is because the government sold today about $178 billion in debt, and we saw rallies in yields that we haven't seen since 2008. You heard what I said, 2008 in some cases. We've got 2-year notes, we've got 4-month notes, 3-month notes, we had 2-year yields. It's all over the board as the government's putting money back in the coffer. And the reason they're putting it in the coffer, tax season's begun. I'm waiting for my tax refund. I imagine others are. And they're waiting for payment to come in, and if you owe, you probably postpone it to the very end. Then we have all the new defense spending and everything else, so it's a heck of a time. What's the stock market doing? You know, on the weekly area chart of closes, you can see that for all of 2017, you hadn't been under this 18-week average of closes, and now we got under it, we went back over it, and we're trying to come under it again. For the week, we're starting off down 21 points. When we go to a regular bar chart, it's sort of interesting because you came down hard, you had a good bounce, fell back, didn't make a lower low, rallied up, and seemed to be stalling a little bit. The swing line tells the better story because it shows you that you've got these higher lows, 3 of them actually, you got a higher high. If you were to take out 26, 27, you would break the pattern of higher lows and higher highs, which is called an uptrend. When you look at where the rally stopped, it's very telling. What did I tell you? I told you before I got ill that, and this was right here, Wednesday was the last day I was here, that if the market rallied, I would not be surprised to see a battleground show up around the 18-day average of closes. On Thursday, you had this rally. Friday, you got up here, and now you're back there. So I'm going to stick with what I said. The battleground is right here. The swing line is up, but the market is closing under the 18-day average, which means the two fight each other, and you have a bunch of nothing. When we take a look at Bollinger Bands, they're far away. They're at 25.56 and way up here at 29.07. So theoretical resistance is coming in from those bands. Remember what a Bollinger Band is. It's an algorithm designed to keep the market trading within it 95% of the time. They become very wide when you get big volatility in a market. As the volatility comes out, they'll start narrowing in again. You can see back here how narrow the volatility got in the market. When we look at momentum, the momentum is still pointing to the upside. So it's a very confusing chart picture. The bulls will say if they can get prices over 27.54 and close over the 18-day average that the trend of the market is up, which it would be. The bias would be up at that point, and momentum would be pointing up. The bears will say that the market is failing against the 18-day average of closes. It's worked out of an oversold condition from this big break that it had, and it's no more than that. Both stories seem to make sense to me. When we come to the Nasdaq, first, you're in overbought territory. Any reading on the momentum indicator called a slow stochastic, my interpretation, not the traditional, is any reading over 70 puts you in overbought territory. So I think we're overbought. The market is in an uptrend. Higher lows, higher highs, and it closed over the 18-day average of closes. The question one would ask themselves is, if you bought the market against the 18-day average or any number, where would you put a stop? If you're putting it under 64.56 and a quarter, the last break low, you do realize you're talking 200 and some odd points. Monster amount of money, a couple of $1,000s. I don't see traders really doing that. So I don't know what's going to go on right there. I think you need a better chart pattern. The Dow is more similar to the S&P. It's got the pattern of higher lows, higher highs, failing against the 18-day average, and momentum was lost as we got up to that 18-day average, and it's out of its oversold condition off the break. In the Russell, you've got a market that is stalled out against the combination of the 100-day average and the 18-day. The market also has the swing line up. The price is settled under the 18-day average. This is what you call, in my opinion, a market that had a big break, let's say double-digit breaks on all the indices, got into oversold territory, has corrected, and now the question is, what next? Could it get another big break from here? There's no reason why not. Could it base out and say that was it? No reason why not. There's too much unknown is the problem, and the risk factors are monstrous in the market right now. In the VIX, I think you'd agree that looking back, that moment we got to 50, caught all the people that were so lackadaisical. Before I left on Wednesday, I'm pretty sure I had mentioned last week that one of my tip-offs at the beginning of the year was that I read about a well-known trader, an advisor, if you will, money manager, that got tired last year of using VIX strategy to protect his portfolio. I promise you, I've been there, 4 decades of trading. The market waits for you to say, enough of this, I'm going to break my pattern, and that's when it gets you. It's been that way all my trading life. I mean, trading is a discipline. It's, you know, I was an airplane pilot for a short while. And what I loved about it, and I was scared of flying, believe me. I love flying. I hated landing. Was the discipline. That's what I loved about it. You check everything off before that plane, before you ever start the engine, before you buckle in. You're checking everything. It's too late when you're in the air. Well, when you got yourself invested and you're removing your protection because it didn't work, I've said it before, I'm going to say it again. The reason you have insurance isn't to collect on it. It's the what-if scenario, and that was almost a kiss of death. So what has happened now is the market has fallen back, probably lost that volatility for a short period, but it's going to stay on traders' minds. This rally broke a number of inverse funds. I mean, that's fact, not my opinion. They've closed down. They had to pay their investors off, blah, blah, blah. My point is, I realize markets change, but principles don't. You've got to always remember that. In the bonds and notes, you got all this debt coming at you right now as the government's funding away and as the Fed is shrinking its balance sheet. You can argue till you're blue in the face. The problem is that you're in a well-entrenched downtrend. Yes, you're going to get bounces. Let's assume you lose the embedded reading. You can get a bounce back to the 18-day average or higher. But for the moment, with all that supply coming on, you've got lower highs, lower lows. You're in a downtrend. You haven't been back over what I call the line in the sand, the 18-day average of closes, in all of 2018. That's a well-entrenched downtrend. It's a flip-flop of what stocks did, if you think about it, and that's the kind of event you're in. You're in watershed events. We're looking at interest rates going higher for a long period of time. Now, the pace that they go higher, where they end up, I don't know. But are they going higher? Are the pressures there? Yeah, they're there. The Fed is saying they're there, so it doesn't matter what I think. The Fed is saying there. What's the rhetoric being tossed about right now? The question is 3 or 4 hikes, not is it 2 or 3. So keep that in the back of your mind. You got lower highs, lower lows in the bonds. You still got your embedded reading. Lose it and a correction comes. And it can be a nasty correction when it eventually comes. But that doesn't change the longer-term pattern, which is probably still to the downside. And I think until you lose all that momentum, the trend remains down. In the 10-year note, lower highs, lower lows, riding the lower Bollinger Band, embedded reading. It's all bearish. When I come to the dollar, okay, you didn't quite get to the upper Bollinger Band. You certainly hit, past couple of days when I wasn't here, the lower band, and you've rallied back to the 18-day average of closes. In the process, you're not in a trend. You have a higher high, a lower low. What you're actually doing is you're taking the Bollinger Bands, do you see them? And you're putting them sideways. Now you might think, okay, the U.S.'s interest rates are going higher, that's bullish to dollar. And under certain environments, that's true. But if you get to an environment where you got the economy starting to possibly slow if interest rates get ahead of themselves, and other economies still in an easy money policy where they're growing maybe more than the U.S., where you get these crazy balances. And that's what the dollar's fighting. It's back and forth just like that. In the euro currency, you still have a pattern of higher lows and higher highs, but you tell me, this is last Thursday when I wasn't here. Here's Wednesday's trade. You had an outside day up. If you don't take this low out, the odds favor that if you continue rallying, one of the spots it might go up to is the upper Bollinger Band. Why? Because Bollinger Bands keep the market trading within them 95% of the time, and often when they go sideways, they act as just one of these type markets. Market tries rallying a little bit on Thursday. Friday, you get right up to the upper band, get a big reversal down. You tell me where the market fell back to. 124.15.5, 18-day average, 124.16.8. Look at where you're at right there. And today, today you break back a little bit more, which is okay. We'll get rid of that. There you are. Now, let's take a look at the pound. In the pound, we've had a bit of a rally, but it's interesting to also listen to Mark Carney, the head governor of the Bank of England, who is saying the bank is preparing for that other shoe to drop, and they don't know what it is, but that's what the banks do. Okay. I view it as a market that's got higher lows, higher highs, got back to its 18-day average, ran out of momentum, and it's looking for what next. That's my view on that chart. In the Japanese yen, you've lost, and let's just see here. Take a look at these numbers, the embedded reading. Both numbers are over 80. Both over 80, not both over 80. So that was Wednesday. Thursday, they're both over. Friday, they're both over. Now let's go to today. They're not. You have a market that's just plain overbought, had gotten up to its upper Bollinger Band, finally gave up that ground, could sink back to the 18-day average to get itself in balance. Is the market a buy in an overbought condition? Well, the way I teach charting, no. It doesn't mean that you might do it different. I'd say let the market work out of its overbought condition and see what develops on the chart. In Bitcoin, you got down under the lower Bollinger Band at the beginning of February. You're now coming to the top of it. What would you be doing here? I'll leave that up to you. I know what Ira would be telling you. The market's overbought. The pattern of the chart is not a trend. You got a higher high and a lower low. If you believe in the Bollinger Band theory, as I do, until the market starts pushing these bands out, I'm looking for resistance up here at 11,938 with support back at the 18-day average, and I'm waiting for a trend to happen. What happened is you broke the downtrend. You haven't begun an uptrend, and admittedly, this market went from 59.70. It's practically doubled here in value. A good thing for it, a lot of regulators looking at it. Yes, that's a good thing because that'll bring people to the market if they make it regulated. In the crude oil, this is still that difference between April and WTI. Do you not agree that crude on its own hasn't really gone that far? It's been the spread that's gone. And you take a look at a chart. I'll argue this with you. Come into Chicago. I'll be happy to argue it with you. But you've got no trend. You're just drifting against that 18-day average of closes in the Brent. In the crude, you rallied back up. 62.66 is the 18-day average. Excuse me. You hit 62.65 and you pulled away. The market has the pattern of higher lows, higher highs, but it's not over the 18-day average. And even if it were, if you're back over that, to get back under the lows, 400 points, $4. It's a broad trading range. In the gasoline, today's rally carried the market, actually past couple of days, got you over 191.72. So at first you had lower highs. Then with this rally, you've got a higher low. So I'm not going to call it a trend. And the market seems to just be in a correction phase at this point. Remember, we're switching over to summer blends very shortly now. Natural gas finally got a bounce. The rally, 264.20, was taken out. So we got 266.20, 30 is the high right, no, 20 is the high. You got a lower low, higher high, no trend. You are embedded. That stays bearish. So this rally is still something the bears are looking at and probably pursuing until the red line gets over 20. When that occurs, I would expect price to make a run at the 18-day average of closes. You know, the nice part is now, here we are, and we're in the month of what? We're in March. Well, we're in February, but the March edition of Modern Trader is out. And here you go with it. Bullish coffee technicals are highly caffeinated. That's one of the stories. Trading the bond fund ETFs. We just talked about them. This gives you an idea of what they do. And, of course, they have their daily market focus. Now, the cover of the magazine this month, let's show you because you haven't seen it yet probably. Alternative data, 2018 crude oil outlook. And these are the different stories. So you're going to see it carries stocks, ETFs, derivative ideas, earnings will be in there, cycles if you're a cycle trader, Forex articles. If you're a trader, this is a must read. And then you get to the technical part. Chart patterns for the airline stocks, trading the bond fund ETFs, becoming a doji master. You know what that is? Those are the candlesticks if you're a candlestick trader. I have enough trouble with a regular bar chart trying to memorize, what is it, I think there's the top 15 candlestick patterns, and yes, I did use them. I'm pretty comfortable with what I do. So here's the different stories. Now, the value of this is $79 a year to get both the magazines sent by email to you and the daily articles. We don't charge that. Through our company and our long relationship with Modern Trader, you can get it for free. All you need to do is give us a call. You can go to our website to sign up for Modern Trader. We'll be certain to get it in your hands. You can click up here or underneath us on many websites. It says, click here for Ira's free information. Feels good to be back. I appreciate the kind words, and I'll see you all tomorrow.